Of course, this is not financial advice and for entertainment purposes only.
Investors, welcome back a very special guest, Mr. John Tinsman, the CEO and founder of AOT Invest and the portfolio manager of the AOTG ETF, which is one of the best performing ETFs this year in 2025 and could have continued success in 2026. Now, AOTG is a high quality growth portfolio embracing low marginal cost companies, and AOTG has been one of the top performing growth ETFs in the past 3 years, which has had better returns than the S&P 500 and even the NASDAQ 100 as well, and so many other popular institutional growth ETFs. And AOTG is also outperforming ETFs like SCHG, VOO, XLK, SPMO, VOO, and even QQM since, or should I say, in the last 3 years and even in the last year as well, which is super impressive. So congrats to you, John, on once again all the success, and maybe in 2026, AOTG could be one of the top performing funds again as well. So I'm going to throw it back to you, John, on how are you feeling about being on the channel and the past recent performance of AOTG?
It's really an honor for me to be back. Since we did this first video, I know a bunch of your people that watch your show. They're very smart investors and they really think about these decisions judiciously. And a lot of them bought AOTG after. So I think it's an honor to be able to come up and talk with you and also connect with my shareholders because I know there's a big portion of my shareholders that watch your show. They use that to try to make good investment decisions. So it's a good chance for me to come in and connect with everybody and give you guys an update on just what AOTG is doing, how it performed the last year and 3 years, and since inception, and what the portfolio rebalances look like. Also, just like what caused some of that outperformance, and what do you think can continue to carry forward into the future? So, thank you, Marcos.
Now, as a quick disclaimer, I do own about $28,000 of AOTG, so I am a good amount invested in this fund because of how much I believe in it. And also, this is not financial advice. Do your own research. Once again, investing involves risk, so do your own research. First question for you, John. For those who might not know who you are, can you provide a quick background on yourself as well as why you launched AOTG?
I'm the founder and CEO of AOT Invest. I launched the AOTG ETF in June of 2022. I did that after I was managing SMAs before that, which SMAs are separately managed accounts. So I was buying single name stocks. I decided I wanted to run that strategy into an ETF. ETFs actually offer unparalleled tax efficiency for investors when they turn over the portfolio, whether you're in the S&P 500 or you're in the NASDAQ 100 or you're in a fund like SPMO or AOTG. These funds typically don't kick out capital gains when they turn over the portfolio. So it's really beneficial for investors that are long-term focused. So I brought this strategy from an SMA into a public vehicle, an ETF. And one of the reasons why I started AOTG and started investing personally myself, my family has a fertilizer company. I learned it's more of a value company, and that's what you can pair it to. And there's companies actually like it traded, in the S&P 500 and on the NASDAQ and stuff. But public fertilizer companies. I just learned how hard it is to grow as in certain industries and how hard it is to earn a profit when the profit margins are very slim, and it makes growth usually unprofitable and dangerous. I wanted to invest my money and my family's money in a way that had a better chance of growing and to perform better long-term. And so I came up with this investment vehicle for us, and we have almost all of our own money in it. And that was the reason why I made it. And when it's public now, the public and Marcos and you guys all have the opportunity to be part of it. I believe in this. It's what I do. With my own money. If you guys like it, you can come along and we'll talk about it a little bit more. And but really, I made this to have good returns for shareholders and focus on low marginal cost, which is the exact opposite of something like a fertilizer company. These are companies that can grow at 100% profit margins. They can grow without debt. So I view them as being a lot safer for investors. And because they grow at such high profit margins and without constraints to growth, because their products cost very little to make, they basically can have a very long growth runway and increase their earnings by multitudes. And I think in the long run, there's almost 100% correlation between earnings, how much a company actually earns for investors, and how the stock performs. So if you can get these companies like AMD or NVIDIA, NVIDIA is earning 18 times what it did 2 years ago. That's in like their earnings per share. So like if you can get those companies, obviously those are the ones that also go up by 1,000%. And so how do you stack the odds in your favor to have the most companies like that in your portfolio? And while a company like a fertilizer company or Ford or Boeing, while it's almost impossible for them to earn 18 times more than they did, like they can't expand their profit margins. It's too competitive. There's not much growth in their industry. It is possible in companies that are almost making their new industries, whether it's like Robinhood, redefining, brokerage services and financial services, or whether it's like, NVIDIA making GPUs, or, whether it's a company like Toast making a restaurant management software and payment processing. So these companies kind of rewrite what it means, just like Apple invented the iPhone, and just like Microsoft invented the Office suite. They kind of make their own industries, and they can do it at much higher profit margins, and they really innovate and drive innovation growth across the world. So I like these companies the most, and I try to stack the portfolio with these highly profitable, high growth, high earnings growth companies.
Now, what's been driving the recent performance of AOTG? Because it seems like if the S&P 500 goes up like 20% in the last 3 months, that you're like doubling it. And you're basically been doubling and crushing that index, which is super hard to do. And you've been doing it consistently since the inception of AOTG.
So my research basically said that like there was a half of the S&P wasn't growing, right? And what half of that was? What was the half that wasn't growing? To me, it was the high marginal cost companies. High marginal cost is when it costs 98 or 90% of what you can sell the unit for to make it again. So like when you build an airplane, you have all that steel and it costs a lot just to build it again. But like when you are Visa and you're processing payments, one swipe doesn't cost you anything extra. So basically, I said, well, what if we take out that portion of the S&P 500 and even the NASDAQ that's not really growing and has high marginal costs, and we only focus on the part that I think is actually driving the S&P 500 performance. And so that's what I did, right? Like if you look at the top holdings, these are mostly blue chip companies. You're right. It's had a very good 1 year. It's, I think on the 3-year chart, it's annualizing 33% annualized over 3 years, which is an incredibly high number. Like if I just like go through the top holdings, right? NVIDIA is up 31% in the last year. AMD is up 33% in the last year. Robinhood is up 400%. Taiwan Semiconductors, 54%. Toast, 31%. Google, 48%. Microsoft, 21%. And, there's companies like Amazon and New that aren't up as much, 15% and 3%. And then there's another one like AppLovin that's up 300% in the last year. So you can see the average of that is a very high number, and it's much higher than the S&P 500. And I think what's really causing that is if you go through like the net earnings growth or like the net income growth across those companies, you'll see like whether AMD is growing at 150% net income year over year, or NVIDIA at 54%, or companies like AppLovin at 164% and Shopify at 429%. You'll see that like there's very high net income growth in this portfolio. And at the end of the day, I think that's like what drives the high performance, that these companies are growing their earnings. A lot of them well above 100%. And a lot of the ones that aren't growing their net income at 100% year over year are, not that far under it. Like Taiwan Semiconductors, another top holding, is growing it at 60% year over year. So look, these are the reasons why I'm overweight those companies, right? And like when you buy a company like the S&P 500, ETF like the S&P 500 or Charles Schwab Growth Index, these are indexes that are weighted on market cap. So they're just the only way they decide how to put, like what weight to put on the company is simply what's the valuation that it trades for. While like the way I'm mainly weighting is by earnings growth. So if it has really high earnings growth, you're going to see it at the top of the portfolio. So while like the Charles Schwab or the Vanguard Growth Indexes, while they might have, small positions like under 1% in Robinhood and AppLovin, because those names are like the highest growth in the market, definitely in like the S&P 500, and they're growing at their net income at, 400% year over year or 100% year over year. Those ones are in the top 10 holdings for me. And I have a position that's many multitudes their size. And I think that's what's driving a lot of that outperformance actually, by being able to focus in the highest growth, highest profitability growth names in the whole market. And like, isn't it interesting that like, we were talking like a couple months ago, AppLovin got like a top 10 position got added to the S&P 500. Robinhood got added to the S&P 500. Look, like the S&P 500 committee is sitting there just like me, and they say, man, we want to have good growth in our index. So like, how do we do that? We got to add these names also. But here you are, way in front of them, and you're also having a much, much higher weight, because that's like you're concentrating in the best growth. And that, ends up being really good, or it has at least the last couple of years for investors in AOTG.
Just as a reminder, so the strategy behind AOTG is kind of looking for those low marginal cost companies, mainly technology that have high earnings growth and just overall can provide hopefully like the combination of earnings growth, revenue growth, profitability, kind of like that large cap, hopefully provide some sort of outperformance for investors. Is that correct?
Like if you look at the charts of like the best performing ETFs and mutual funds all time, you'll see that it's like mainly large cap. And there's a lot of different theories, but my theory on why to focus on large cap is that you get a lot smaller stock-based compensation, like as a percent of revenue. So I think that actually ends up leaving more returns for shareholders. And then you'll see that it's mostly in growth, right? And it's mostly in technology that you see the highest returns. And historically, those funds have had the very highest returns. I'm not trying to reinvent the wheel, but try to focus on, what aspects of those things have made them the best performing. And then like, let's make a fund that focuses on those things too, but does it even better. So if we think that growth, performs better than value simply because there's the best earnings growth, well, let's concentrate even higher in the best earnings growth. And if we think that large cap provides the best value, then like we don't need to be like, like the Russell 2000 and have like mid cap names in it. Why don't we just focus on large cap? And so that's really what this is, like a large cap, growth, expanded technology. I want to say expanded because companies like Robinhood and Visa and Amazon and Google, none of them are in the technology index. And I actually think that's a big problem, because when people buy like a technology ETF, they expect those names in them. I would think like, Google and Amazon aren't in there. Like that's a tech company. I focus on this expanded technology universe, that anything really that has low marginal costs. And there's interesting names in there too, like NASDAQ, right? Like NASDAQ is an exchange, but what do they really do? They automate like exchange services. So like they're not people in the pit anymore holding up numbers. This is all done by software. And so the more you can automate, the better, the lower your costs can be. You can pass those costs on to consumers. And you can also, like now everybody from all across the world wants to list on the NASDAQ. And so you have tremendous growth, right? They're growing their net income at 103% year over year. And like, that's a really good company. Like it's in AOTG. I like the net income growth. I like the automation. I like that I really consider it a software company, even though it's in financial services and exchanges. That's really what AOTG is all about, that low marginal cost, high growth. And for growth investors that are considering a growth ETF, like I think if you would really sat down and thought about it, do I want the highest growth in the portfolio, or do I want something weighted by market cap? I think you would say, well, no, if I'm investing in growth, I want the high growth. And I think that's where AOTG can play a good role in their portfolio by increasing the growth metrics by multitudes over these indexes that are really the leading growth funds.
When you hear the term of risk, what are the risks of investing in an ETF like AOTG compared to your broader based indexes? And even just like the qualities of risk of a low marginal cost company versus anything else that maybe is unprofitable company, maybe it is high marginal cost?
So basically, I think in the long term, all right, the biggest risk for investors is that what they buy doesn't grow, right? So like, say you buy a company like Ford, and 5 years from now, like the competition from Toyota and Hyundai is like just too much. And so their revenue is down 30% in 5 years. Like you're going to pretty much, like the chances of you losing money on that is very high. And so like, that's the biggest risk. So I actually think when you invest in growth, I think that's one of the safest things you can do, because like if you buy a company like Robinhood, their net income's growing at 100% year over year. So that gives you a lot of safety, because if the stock doesn't go up or the stock falls, you have the income going up so quickly that it's really like you'll see the valuation metrics plummet, and eventually people will start buying it because it gets so cheap, like on like the PE ratio or the price of sales. So I think that provides a lot of growth. Now, in the short term, these things can have higher volatility. And so that's a risk that you might see it whip around more than like the S&P 500. And like, why is that? Well, you have to remember that like the way you outperform the market is by beating expectations. And so people don't expect these companies to grow their earnings by so much, right? But I do, right? Because I know that the income growth can come at 100, or the revenue growth can come at 100% profit margins on additional sales, right? Like what's it cost one Microsoft Excel for them to make one additional one? Like it costs them nothing. It's 100% profit margin. And you go down the list of the names, whether it's like AppLovin's, software, right? Like these companies actually haven't increased their expenses year over year, like AppLovin. At the same time, they're growing their revenue at 77% year over year. And the stock's up 300%, by the way, too, in 1 year. And it's up a lot more than that if you go back further than a year. These are companies that I think provide the best safety. But here's the thing. You have a stock that goes up 40%. Right. Let's just say it does that in a month, like a lot of these ones do. Micron it went up over, I think, 40% in a month. And like the market's trying to figure out what they're worth, right? So they're like, wait, is the earnings going to be super high, or is it going to be negative? And they don't a lot of the people don't really know. So like the market's trying to do a price discovery on something. And so when it goes up so much, there's going to be some price discovery to the downside sometimes too. So we've even seen like this last week with like what it was that Trump tweeted, like that there was going to be Chinese tariffs. And you saw some of these names like Robinhood drop like 5, 6, 7%. Then you saw the next day they came back a lot of the way. But there's definitely higher volatility in some of them. And I think that's simply because the market's trying to figure out what they're worth. And even though they're going up a lot, like that doesn't mean they can't take little, downswings that can be very sharp at times too. So I think there's points when you're going to see higher volatility in these names. And by the way, like when you concentrate, so like say you've got like a growth index and it's got all the names in it, but now you're concentrating in, low marginal costs. You're taking out Starbucks and you're taking out Costco and you're taking out Apple and things like that. And then after that, you focus even further on the best net income growth and the best earnings per share growth and the best revenue growth. Well, that's going to whittle the names down. So you're going to have higher concentration. And I think it's very well worth it. And if you look at the historical performance, right, it has been worth it since inception and since over the last 3 and 1 years. Yeah, it comes with a little bit higher volatility at times.
What's one thing that investors misunderstand or often get wrong about AOTG?
There's a tendency when people look at these funds to try to find some fund over a certain time period that's beat it and then say that fund's better, right? And so sometimes it's like a leveraged ETF, which takes way more risk and it's not necessarily a good comparison because when you're leveraging something, you have twice the downside also and you have interest expenses. Sometimes it's something that is like a momentum ETF and stuff. And so these are not the same sort of funds. I think it gets compared to SPMO a lot, which is really flattering, by the way, because it's one of the best, and I think AOTG's beat SPMO on the last 3 years and something. And I think within since inception, it's neck and neck, within 1 or 2% the last time I checked. SPMO is a momentum ETF, but AOTG has nothing to do with momentum. AOTG bases on fundamentals, not the stock technical analysis of the momentum of it. So basically these are very different ETFs. It's great that they're both high performing, but I think one of the reasons why SPMO does so well is because people, like me are buying the best growth in the market. And that's, those stocks are having the best earnings growth. And so they're going up the most. So SPMO has a lot of exposure to high earnings growth, but it doesn't have as much, I think, as AOTG does. So while you might get, high performance, even though there's not not nearly as much overlap as people would think. I think in the future, because there's so little overlap, you could see a much bigger divergence in it. And if you believe SPMO is doing well because it has such high earnings growth exposure, then you would think AOTG in the future, if that's your theory, could do even better if it has better earnings growth exposure. So like that's my personal belief. Like everybody should look at these funds and like do their own analysis. And like AOTG is an actively managed fund, so it does have a higher expense ratio. That's more in line, I think, actually on the cheaper end of actively managed funds. Whereas like if you're just an index that is like rules based and you're not really adding any like special human based decision factors, then like those ones do have a lower expense ratio.
TipRanks analysts have a forecasted price target for AOTG, an average one of $64.06 in the next 12 months, which would represent over 15% upside. And 41 analysts rate AOTG a buy, 7 a hold, and 0 a sell. So Wall Street analysts are pretty bullish on AOTG for the next 12 months into 2026.
I'm hoping for another 33% year. So 15% would be a little disappointing. I'm guessing they take that based on like what the Wall Street analysts have for like the underlying stocks. So like they're doing like an average weighted based on like the Wall Street, forecast for the stocks itself. And like I said, I think a lot of times these Wall Street analysts get it wrong because like you take a company like Nvidia and they're like, well, like 2 years from now, we can't possibly forecast it'll grow 18 times earnings. Like they can't imagine the upside that some of these companies have that can have sales at very high profit margins. The same things for AppLovin, right? Like I remember in Robinhood, I remember the stock, like the price targets are always way below the stock. And as the stock keeps rallying, all the analysts keep raising their price targets. So like, I think like some of that can throw it off. But yeah, I would be more optimistic than that personally. There's always some macro exposure. So like some of this is totally out of your control, of what actually goes on in the global economy and things like that. But at the end of the day, things look pretty good. The Fed is cutting rates. I think that's going to be good to get some money out of the money market funds. At the end of the day, though, like the fundamentals, like I said, the net income growth across this portfolio is very, very high. And that just means that these companies are very healthy and doing very well. And I'm bullish. I'm bullish on them, and I'm bullish on American innovation that we can build it in the US, whether it's like software or whether it's semiconductors or whether it's financial services like NASDAQ. And then we can sell that service and that product across the world at very high profit margins. So we build it here. Everybody's like, how much bigger can it get? And then we go sell it to another 7 billion people at near 100% profit margins. That's very good for investors. And I like that. It's kind of just like your show, Marcos, how you can add another 50,000 subscribers. Hopefully we do that. And it doesn't cost you anything, right? Like it comes at zero additional cost. And so that's a really good business model for me. I like it a lot.
You've managed AOTG, John, for about the past 3 years in some change. So what's your biggest lessons and takeaways since then about investing, or just that you've learned about managing AOTG?
Since I've started doing this, I've learned that whenever you cut something that has like really high revenue growth, like let's just call it a name like AppLovin, and like it's growing its revenue at 77% year over year. Whenever you cut names like that because you think that the stock gets overpriced, usually like it just keeps going up and you've missed a lot of profits. So like, I think you have to be really careful, like when you see winners in a portfolio. Let's just imagine there's like a person and they own a bunch of value companies, and then they own a company like, like Nvidia. And because Nvidia goes up 100% and then everything else they own doesn't go up at all, they think, oh, I better cut it. And so they sell Nvidia because it's going up so much because they think that means it can't go up anymore. And then it goes up another 100% after that. And so like, or another 500% after that. And so like, I think that that's like fairly common. And I think investors need to be really careful, and just like portfolio managers do, that when they do portfolio turnovers, like say they're rebalancing, that they're always trying to raise the portfolio growth. And like we talked about the last AOTG rebalance, right? This is a rebalance that was lowering the metrics. So it was lowering the price to sales ratio. It was lowering the PE ratio, and it was raising the growth metrics. So like there was names in that the fund had made 600% in like Shopify or Spotify. Spotify's growth was slowing and it turned actually unprofitable, right? So if you could take Spotify out of the portfolio as the growth dipped under 10% and it stopped making money, and add that weight to AppLovin, who's growing at 77% revenue growth, and the earnings growth is even higher than that. 164%. You really raise the growth metrics of the portfolio. And that's, I think, what you want in a growth fund. You don't want to take the best growth out and replace it with companies that aren't really growing as much. So that's what I focus on. People that are managing their own portfolio of stocks, while they can't do this without tax hits, unlike an ETF. So I think they have like a little bit harder time trading in and out of stuff because they don't want to recognize capital gains. Definitely always trying to focus on the growth metrics of your portfolio, and a rebalance that wins. And what I always try to do is lower the price of sales, lower the PE ratio, and raise the revenue growth and the earnings growth every time. And I think that is one of the secrets of having a really good growth portfolio. In addition to focusing on large cap, in addition to focusing on profitability, like there's a lot of growth names out there, like ETFs, like ARKK, or the Granny, GRNY, or the IVES, IVES. And these companies, these funds, one, they have a lot of small and mid cap, and two, they have a lot of unprofitable companies, and three, a lot of companies that have like crazy stock-based compensation, like in excess of 20% annualized of revenue. And like basically my back tests, I thoroughly back test these things, show that like that doesn't raise performance historically. That actually, while there might be some really hot years where they go up a lot, it also, just like we saw in ARK, there's years where it drops 80%. And like you saw the tech index, and the year ARK dropped 80% or something, the XLK, the tech index, only dropped 35%. So, and that's because it wasn't nearly as much in the small cap, the mid cap, and it wasn't nearly as concentrated in unprofitable companies. And so there's a trade-off there, and I think it's worth focus. I don't think that you raise your performance long-term focusing on the small and mid cap and focusing on the unprofitable companies. And I was actually talking, we were at Blossom, we were in Chicago together, we were at the SIBO, it was awesome. And I was talking to one of the YouTubers, and they were like, well, you would have missed Amazon. If you wouldn't have done that, you wouldn't have bought Amazon. And I said, yeah, but if you had missed Amazon, but you had bought Google and Microsoft instead, because those ones were profitable and, doing buybacks and dividends, like those ones would have gone up like pretty much just as much as Amazon. So one, you wouldn't have lowered your returns. But the thing is, when you're trying to pick the ones that are unprofitable, like Amazon, you also buy a bunch of other, say, little e-commerce companies that are unprofitable. And those ones they go bust, right? Or they don't go up, they go down. I mean, we've seen it like even like how Yahoo didn't do nearly as well as Google, right? So when you're focusing on the ones that aren't making money, you have a lot more losers. Whereas if you focus on the low marginal cost, high growth companies that are making money, just like you saw in my top 10 holdings this year, I haven't had any that have gone down. So you kind of eliminate you can't say it with 100% certainty, but you definitely reduce the odds of losers by a lot. And I think you actually raise the performance in the long term. You don't hurt the performance at all. You help it. So that's the difference between AOTG and those funds. And I do agree you miss some names like Amazon, but it doesn't mean you lose performance.
It seems like you care about AOTG shareholders and just about your fund so much as a whole. You have your own money invested in it, as well as in terms of you having such high conviction on your own fund versus the most popular institutional ETFs. So like, why do you care so much about your own fund, about your conviction in your own fund, and just why your ETF is superior to pretty much what we all know is like a good way to invest? Like, for example, like broad-based indexes, buy the S&P, buy the NASDAQ versus your own actively managed fund.
Yeah, I mean, I understand the ins and outs of managing businesses very well, given that we have these businesses in Iowa and our family companies have hundreds of employees and they're value oriented. And I know how hard it is to grow, right? And so there's a lot of investors that want to buy the dividend and they want to, get these companies like Starbucks or Altria. And these are companies that are not growing, right? They're just kind of staying constant. And that's because the growth is so hard. Like for a fertilizer company, we have to build new factories, we have to build new retail locations. And then just to win the business, like because somebody's already selling them fertilizer. It's not like we're inventing our own industry like Microsoft or Apple or Visa, right? Then you have to sell at a loss just to win business. And then you have to sell at a loss for a long time so that the competition doesn't win it back. That's all while you're incurring huge amounts of debt just to grow. And so I don't think the growth there is safe or profitable. And I understand, like, I love those companies, by the way. We need companies of all sorts. I just don't want to invest in them. So my conviction comes just from my real world experience of seeing the family company for decades. And then like my real world experience of investing and knowing, hey, I've had really high returns investing in, technology names and investing in, because like I was doing this when I was in high school and stuff, and I would pick names like Boeing, and Boeing, like my theory was it was an oligopoly, so it should be able to return well. And I think Boeing's maybe gone up since then 100%. But I also picked names like Apple and Visa, and those ones have gone up 8,000 and 3,000%. And so like I kept seeing it again and again across my portfolio. I bought like a REIT, of the Vanguard Admiral REIT. And like it didn't go up at all since like 2012. And I don't own it anymore. This was back when in high school. But the other names I bought, like Microsoft, are up, 2,000-3,000%. So we are sitting here today and we have that same choice. Do we want to buy those companies that we think will go up 100% over 15 years? Or do we want to buy the companies that have gone up, thousands, that have the potential to go up thousands of percents? And like, that's the difference between, if you have $10,000, that's the difference between having $20,000 in 15 years or having hundreds of thousands of dollars in 15 years. And I know I've seen it myself. I'm grateful and blessed that I've been able to do this for a while, but also grateful and blessed that I have the business experience of understanding like what management works and what to look for in management teams, but also what sort of business models like have the highest returns. And so like this is really about focusing on the best growth in the market at the lowest risk because they don't have debt and at the highest profit margins, which I think just totally skews the risk reward metrics compared to, historical investing. And like the XLK, so that's like the S&P Technology Index, its annualized returns are 22% for the last decade, which is that's crazy. I don't think there's ever been an index that's done that well over a decade, like a broad-based sector index. And you have to remember that leaves out a lot of the best names in the market, like Amazon and Google and Visa and all that. So had you had, and by the way, I think that's 2,000% or something over 10 years. So that's really good. If we all had a 2,000% return, we'd be super happy. But AOTG is trying to focus on improving on that. And it's beaten that index since inception. It's beaten it in the 1 year and the 3 year, right? By a good margin. If you can focus on the lowest marginal cost, which is really a better definition than they use for the technology sector, because it's broader and it includes those true low marginal cost companies. And then you focus on the best growth within them. How much better could you do than 22% annualized? And I think there's, now while past performance is never a guarantee of future performance, I'm bullish on technology. I'm bullish on innovation, and I'm bullish on these sorts of business models that they provide a lot of value. I mean, when you think about it, why did we all start using Visa in the first place? It's such a pain in the butt to pay with cash, go to the ATM, then you get bank fees. Then the company has to have an armored car come pick it up. And the fees are crazy all around trying to maintain that ecosystem, in physical bank branches when you could just do it all digitally, reduce costs by a factor of 10 and increase the ease of use by a factor of 10 also. So you make it less time consuming, better, and cheaper for everybody. And so bank fees have fallen a lot. These are technologies that save everybody money and time. And basically, a lot of times it helps people make more money because there's lower costs. So higher profits, lower expenses, better ease of use. And so that I believe the adoption of these things come naturally, right? Just like I believe restaurants are going to continue to adopt the Toast restaurant software, and people are going to continue to, buy more semiconductors as we digitalize more of the economy. And so I believe the demand for these things just it has to be big because they save so much money and they make so much money for people. And we all love using them. None of us would want to imagine a life without Microsoft Office, right? It's not something I'd want to do. And so they're so entrenched. But here's the thing, every dollar that they reinvest, they always make the product better. So the innovation is so fast in these companies. So you've got Microsoft, all of that revenue, they can use whatever 50% of it, and they can use it all for innovation and making new products, improving the use of and improving the utility. A fertilizer company basically has to spend 95% of the revenue to buy the ingredients to make the next ton of fertilizer. And just like Ford has to buy all the parts to make the next car, that leaves 50x less for innovation. So they don't innovate as quickly. I mean, think about it. Ford made a car 40 years ago. Boeing made an airplane. Nutrien made a ton of fertilizer. But what is Apple and Microsoft and Visa and NASDAQ? What have they done in 40 years? They're innovating so quickly, and then they go and they sell it to the rest of the world. So like, I think that this is very compelling, and I'm very comfortable with my own money doing it.
What type of investor is AOTG for? Because I know so many types of investors, younger investors, growth-oriented investors, older investors who own AOTG. But in your, I guess, opinion, what type of investor is your fund for?
So I think it's for people that want to seek long-term capital appreciation. So these are people that want to see the values of their, accounts go up. There's no guarantee of that, of course, but these are people that are seeking that, like say they're not seeking dividends. People will notice that there's not a dividend yield in AOTG. And you have to remember, AOTG is buying companies that do buybacks, right? So like large buybacks in AMD and NVIDIA, large buybacks in Microsoft and Google. So this is a form of capital distribution that is more efficient than a dividend. So a dividend, when you get it, you have to pay ordinary income tax on it, where a buyback avoids that tax. So you've got 40%, a lot of people, 40% more in the market just from that. So you've got a huge savings. And then that 40% that you saved in taxes, because they're buying more of their own shares back, can continue to appreciate for a decade or 2 decades or however long you want. So for me, focusing on companies like that, it doesn't mean they're not distributing capital to shareholders. It's just that if you want that capital distributed, you have to opt in. And opting in means selling a small portion of your shares. So Warren Buffett, for instance, when he wants to cash out of Apple, he sells a small percent of his shares every year. And that is his form of dividend. But at the same time, because Apple is doing buybacks bigger, he's actually never decreasing the exposure to Apple. He's either keep leaving it constant or letting it grow. And so you have to remember, that's you can do that yourself, and you would have had higher returns than the dividend ETFs out there, or even just buying the dividend stocks, I think, had you done that instead. So that's what AOTG is all about, seeking that long-term capital appreciation. And I know that doesn't fit for everybody, but you still do know, when the money's in your account, you're always able to access it. You don't technically need the distribution cash going in. You could always sell a small number of shares. That will be better in the long term, I think, for investors, in my opinion, in reducing taxation and increasing returns.
When you hear the term or the word diversification, in terms of your own fund, you have just under 50 different holdings, as well as 60% of the portfolio weighted in the top 10, and then technology is a concentrated part of your portfolio. So would you say that AOTG is a diversified fund?
Yeah, so it is a SEC diversified fund. So the rules for that is at every rebalance, the 5% plus holdings have to be under 25%. And then basically you can't be over 25% in any subsector. A subsector means semiconductors. So I can't go over 25% in semiconductors at a rebalance. So if NVIDIA and Taiwan Semiconductors are rallying really hard, I have to sell them at the rebalance, because if the fund goes over 25% at the next rebalance, I have to cut it back. So this is a diversified fund. So investors can feel good knowing that it gives them that. But I think the other thing is, you have to remember, diversification that comes at a cost isn't always worth it. And so my family used to be invested with financial advisors, and they would typically say, oh, you can't be in the S&P 500. That's too risky. Why don't we put you also in a small cap fund and a small cap value fund and an emerging markets fund and a world markets fund? And look, you can have all the diversification you want in the world and own, Venezuelan bonds or whatever. But at the end of the day, if all it does is lower your returns, was it worth it? And so there is if you're diversifying away from the best companies in the market and it's lowering your returns, you do have to wonder, what's the right balance there? And so I think when you're diversifying away from the highest growth, the highest earnings growth, and you're putting it in companies that are shrinking, whether that's a company like 3M or Procter and Gamble or whatever, I don't think that's a good idea of let's diversify more. So I think that you do want some concentration in the best companies in your opinion in the market. And AOTG tries to, balance that, for shareholders in a way that, would be the most beneficial for them and for me as I'm a shareholder also. So, I'm trying to balance that line for everybody involved.
Now, what does a typical day in the life look like for you managing AOTG?
You always stay on top of the earnings, right? So whenever there's earning releases, I'm charting it. I'm putting it into spreadsheets. So I'm evaluating the portfolio metrics, and I'm really trying to keep an eye on, if earnings growth is dropping, like I saw on Spotify, that's a name you consider taking out or reducing. Now, the nice thing about being actively managed is you have a little bit of flexibility. So it's because you're not rules based. If you see a company like AMD, see their earnings or the revenue growth kind of fall off because their CPU business is being hit, you can hang in there and not have to sell it when you see the GPU business rising at the same time, because eventually you'll see that revenue growth come back with the high GPU growth. So that's like an example of how the flexibility is beneficial. But really, it's just about being involved in the stocks every single day. And you have to know, like, when you're investing in a fund like this, you have somebody that's been reading the earnings of these stocks for decades, like every day. And like they know them like inside and out. So like it's hard for an individual investor, I think, to like match that when they have a full-time job. So you have somebody that really understands these stocks, that understands the history of these stocks, understands the business model, the management team, and can deploy capital in the way that from what they've learned, right? And like I studied economics at Northwestern and University of Oxford, from what they've learned to deploy capital in the best way that minimizes risk but maximizes returns.
In your personal preference, do you like dollar cost averaging into ETFs or lump summing, and why?
Yeah, so I like lump summing, but like my caveat I always say is that for lump summing, I think that it's important to not put in your personal expenses. So like if you know that you're buying a car next month, like that's not money you like invest in the market, right? Like you leave that on the side and put that in a money market fund, right? So you earn your 4%. But like if you have money, like for the next year, you don't need it, and it should be in the market, right? And like if you wait, historically, let's just say the S&P 500 historically goes up at 13% a year. Like, that you're losing 1% a month. Mathematically, that's like the odds. And so like, I always think about probabilities. You could have like a, 50% chance of being right by waiting and a 50% chance of being wrong. But if you lower your expected value, you're only going to save 5% on the downside because you'll buy, but you might make 30% on the upside if the market rallies 30%. That totally skews the expected value of the game you're playing. And you don't want to make decisions that leave you with a negative expected value. And I think when you lump sum in money that you're ready to invest in the long term, that you are raising your expected value of your portfolio, and that's very desirable for investors. But you have to be okay with knowing that the market might drop and not eating yourself up. And there's a lot of investors that it really causes them emotional distress when they see that. And so I think I'm just doing it from a mathematical probability side. I'm not talking about the emotional aspect of seeing the markets go up and down and whether you can stomach that.
Can you remind me on how often AOTG rebalances? And is there like any metrics that jump out to you? Because there's only, I think it's like 48 different holdings in AOTG. So like what metrics jump out to you when you do a rebalance to add a stock to the portfolio or automatically just cut it?
When I do a rebalance, it's all about being a good steward of the fund and deploying the capital well. So like you're just trying to serve the shareholders in a way that you think will be long-term beneficial. You're not trying to put the most trendy names in the top of the portfolio like Palantir to catch the eye of people, but really just trying to be a good steward. And so like what I like to see is I like to see revenue growth over 20%, right? So if revenue growth is under 20%, like there's a good chance I'm considering reducing that position. And if there's large cap names, right, not small cap, but if there's large cap names that are profitable, not unprofitable, that are growing over 20% and they have low marginal cost characteristics, there's a pretty good chance I'm watching it closely to consider adding it, right? So, but then like if you're choosing between a company that's growing at 50% revenue year over year, such as like Micron is growing at 74% year over year. And then you're looking at other companies that are only growing at 20% year over year. Well, you might be like the S&P index committee and choose the higher ones, right? To add to the portfolio. So it's kind of like a snapshot in time of each quarter. If you can get revenue growth at over 20%, and that there's a chance that revenue growth comes at 100% profit margins. Imagine they just like their AppLovin and they sell it for 100% profit margins. They don't increase their expenses at all. Like that guarantee. And so let's say they had a 20% profit margin before. Well, their profit margin is going to jump to 40% and you're going to see 100% earnings per share growth. And that's very good for investors. So it's like trying to play that, knowing that with low marginal cost capabilities, that could lead to an outside, even higher gain in earnings per share. So like if I have a portfolio that is averaging 80%, earnings growth year over year, that I think that that's going to lead to really good. It has the potential to keep doing that into the future because the revenue growth is there. I think that has the potential to, allow the portfolio to continue to grow at 33% annualized.
Now, in terms of what's next for AOT Invest, is there any new funds you're thinking about launching? Any plans for AOTG or just adjustments you might make in terms of, adjusting the portfolio for next year for AOTG?
Yeah. So the interesting thing is that, like when you have active management, you have a lot of flexibility. So like things I'm thinking about AOTG is I thought it was interesting that some of the best technology funds out there have like SPMO. I'm sorry, that's a momentum one, but they have fewer rebalances. So they only rebalance yearly or semi-annually. And so they're using that to kind of like have greater concentration and not have to cut the winners and leave it ride longer. I think that's interesting to leave that door open to a possibility. That way at each quarter or like I can rebalance whenever I want, to be honest. So if I wanted to do it monthly or more, I can. So I'm going to it would just give you the choice of trying to weigh cutting some of the bit winners to meet diversification requirements and versus like always trying to raise the portfolio growth. So it just gives you a little more flexibility. Like I said, I like being diversified. And then for future funds, actually, I have a software platform index. It's the AOT Verify Software Platform Index, and AOT Invest is filed with the SEC. So now the SEC has to review that, right? But filed for an AOT Software Platform Index. So this is very similar to AOT Invest, but it's a rules-based index. It's not actively managed. And it takes like what I've done, because I like to do a lot of research. The research I've done, it takes a lot of the factors, one being low marginal cost, others being return on capital invested, things like that. And it uses those factors to concentrate in that low marginal cost, high growth area. And try to make an index that's better than the existing technology indexes out there. So that's what I'm striving to do. And hopefully we'll see that fund launched in December, but you will have to stay tuned. And, hopefully there's no road bumps along the way, but I'm very excited for it, Marcos.
In terms of you launching new funds, I know that you really want to launch like high quality funds that you would personally probably have your own money invested in. So why not launch, like if you already had success with AOTG, and I'm sure AOTS would probably be another successful fund, hopefully. Why not just like keep on launching ideas that you think would stick well to Wall Street and to investors, but you're just kind of doing what you want, which I think is super interesting because other managers just want to launch new funds, it seems like, every other week.
Well, when you're investing your own money in your funds like I do, so I'm not in this really to make the fees. I'm in this to invest my own money and create good investment vehicles for myself and my family. And so like you really want to only launch funds that you think have the potential to continue to do as well. And, when you have a very top performing fund, it's going to be hard to hit the bullseye every time in a row. So you really want to have very high conviction in what you're launching, not just like, here's a robo ETF and here's an internet ETF and here's a whatever. Like these are funds that you want to put your own money in and you're not trying to do it because it's trendy. You're not like AI themes ETF. And so like I'm trying to do what's really good for investors and create good long-term capital appreciation in funds and give them any fund I create. Hopefully it has the potential to be one of the best performing, long only equity ETFs ever made. That's like my dream. So like I only want to create funds that I think have the potential and, on the back test show they can do that. So, there's another thing I've been looking at. I've been thinking about improving like the momentum indexes and trying to make one that's better. So like I'm really excited about this stuff. I love doing market research. And at the end of the day, all that research I do, right? Because AOTG is actively managed, I can always adopt what I learn into AOTG. So like AOTG is always, I think, going to be my flagship fund. And I always think it's like, if I learn new things that I think have the ability to raise performance, like I can create a new ETF, but I also can just implement those factors into AOTG.
Thank you so much, Mr. John Tinsman, the CEO and founder of AOT Invest, as well as the portfolio manager of the AOTG ETF. Now, you guys can find John on X as well as on Blossom, which will be in the link in the description of this video, as well as you guys can find more information about AOTG and AOT Invest on their website as well. Now, if you guys like this video, please give it a like because this coupon we did.
Thank you so much for watching. And once again, this is not financial advice. Do your own research. Investing is risky once again. And check out our last video on your screen. I love you guys so much. Crush on the stock market and take it easy. Peace.
And thank you
Sweet.
for being an AOTG shareholder if you're watching.
There you go.